Okay, thank you. So this topic, how our trading system work, I have explained before many times, but there are new members always coming in, and then there are some the previous members, they still want to understand, and then I explain some more things which come to my mind. It's a dynamic, so I'm always learning, and there's so much to talk. Basically, in this webinar, I'll explain from A to Z, from the time I send you the trade alert notification to the time we close the trade. So there are many things we can do um, to improve our trading, to maximize. So if you're following someone, if you understand more about my belief or the thing you can do on your at your end, then you can improve. So that's what my objective is. You can read the guidebook, 71 page, and simply just follow the email. But understanding and listening will help you maximize your gains and manage the trade. So managing the trade is very important. So I'll explain. I'll show you some charts that I created quickly today. So this is a Twilio chart I entered here when it gapped up. So when it gapped up, when I initiate a trade, I initiate with a as if I'm going to lose money. So I initiate the trade. I mean, I do my all the work. I will explain. There's a lot of work to be done. There's a lot of work I do. Like I'm a very good student, and I was when I was in the school. I was very good student, studious. You know, the kind of student who completes his homework and finish on time and get the grade A. So trading is also about being, achieving excellence. So remember, achieving excellence. So in anything you do, if you're working somewhere in a company and you're not aiming for excellence, then you're not getting what you think you should be get paid, because there's some people making mistake. People are sloppy. They come home or they come to work late. They leave early. Ha ha hoo in the office. Don't come to meeting prepared. Don't do the assignment on time. All the time talking, gossiping, and bullshitting, and so all this people do at work. And when I was working as a SAP consultant, I've seen it, but I was not like that. So having excellence, so eliminating mistake, optimizing it, fixing things, little things in matters. So also matters in trading. Little thing fixing here there will improve the result. So when I enter the trade, let's say just think that this is a trade which Twilio came on the screen based on some criteria. It gapped up and I'm watching it. So it can gap down next day. So I need to initiate a trade with maybe 1/3 lot or a half a lot, because I'm initiating the trade. So when we initiate the trade, we look at something. We are making a crucial decision, and we are deciding. So if we are deciding, then we need to go long. We could be wrong. So next day, if it goes to the moon, is fine, but the trade itself will tell you in a day or so, or in an hour or so, that yes, you are right. You read me correctly. Now you need to increase your bet. So what happened? And just for example, say here, initiate a little bit, and then look at this next day, the 2 days later, this white bar is telling me, oh my goodness, I got the right trade, and it's bouncing up. This is where I'm accelerating my position. This is where I'm increasing my bet, and increasing my bet and a 90% gain. Now I need to sell majority. If I stick to my, so I'll explain to you how I set the targets, or I communicate the targets to you. So I need to be, if I'm trading options, an option have 90% gain, so I need to take some profit, or maybe majority of my uh, majority of my position here in Twilio. And this is not the only position I have, and this is called tomorrow market tanks. Right now, like market is crazy, goes up Monday and goes down Monday, so we have to balance. Yes, Tom, you're correct. So balancing. So I need to take majority of my gains in Twilio. So here's the red bar. So look at this red bar. This is where the sellers are in. So for me, it means there are some sellers here. So they may come out. I need to sell. Look at the left side. There's some resistance. So 90% gain. Hold some for this resistance. This is at the 80 level. If it doesn't, then I don't mind selling it at a less price than what I sold. Or maybe I can create the spread for the remaining position, or maybe I sell all, and if it dips a little bit and then it starts to move up, I can roll up to something else, some other strike, some other month, something I can do. So this is the Twilio calls we just closed today. Here's the Moss trade. So Moss, we have 100% gain. We sold half. We are still holding because it looks like it's breaking out further. So Moss was trade we entered here. We sold half yesterday on this move, and we are holding it. And currently we have 100% gain. So look at the volume bars also here. Pay attention to the volume bars. Above average volume, nice move and a breakout. So also pay attention to the weekly chart, the monthly chart, etc. So when you're deciding the trade. So this is the Moss chart. Low. So low start to break down. So I caught in the middle. Somewhere I caught it around 197. So when low, like 2 days ago, during the red bar. So I caught the low put, knowing that it has a room to fall further. So puts, and then next day when the white bar appeared, I closed the low puts, because after this down big bar, the white bar appeared and the market is tilting to the upside. So not only you need to pay attention to your position, you need to pay attention to all the indices, all the cash index, all the ETF, all the futures market, and what else is going on. So, the gains were not much, 29%. So we just closed with low put because the white bar appeared, and then this it can set up long above 200. So it may be the low could be going up above 200. So just close it, and we had other puts. Such as RIVN. So RIVN puts, it gapped down in like a waterfall decline, but knowing, so waterfall decline started here, and knowing this is a support level right at the 1550, 16 levels. So if we are entering around 17 and 1550 support, so when we enter any puts or any short or long position, we need to immediately see what's the distance. Where is the support? I'm entering here. Where is the where it can turn around? So that is the price point we need to keep an eye on. So if there is a potential, so for a small price stock, $1.50 distance is a big distance. The $1.50 distance is a big distance for RIVN. For a $100 stock, $1.50 is not much, but for a $17 stock, $1.50 is a big distance. So 44.45, and then I turn around and I went long on again on RIV, and I added to my long position. So I had long position, and so in other words, if you have a long position, you have many options to, if it goes the other way, you have many options to do. So you can list down all your options. If I am long position and if it going against me, what I can do? Step, I can do one, I can do this, I can do this, I can do this, 4 or 5 things, and then you figure it out which one to deploy at that time. So you can, I'm not reading so I have hidden the chat box. So no chat, I'm reading right now. So I just close it. So you can keep typing. Focus on listening instead of typing the messages. And especially if it's a long message. So don't be typing any long messages. Start pay attention to what you are listening. You can type long messages later. So when you have a trade long and then it's going against you, then what you can do, write down the steps. if the long position is going against me, then I can do these the steps to mitigate my losses. Step one, I can do this. Alternate option is this. Number two, alternate option is number three. Alternate option is number four. And at that time, you one of those options you implement. So RIVN started to think. One option I had is to close my long position and just go do nothing, just stopped out, or it's going, it's dropping. So I say, okay, I can even take advantage of buying puts. So if I don't close my long position, I can create a short position. So puts, and but I don't want to lose. So if I have 45% gain in my short position, and I have a long position which is losing the same amount, I don't want, this is my theory, I don't know about yours, so I don't want to lose this 45% gain and lose and come back to zero gain in the puts. So it's not written here, it's a put. So and then wait for my gains in the long. So by reading the support at 1550 and I close at 45% gain, I reduce my cost on a long side by capturing this 45% quick gain, and then I added more to my long position, so much that I'm now in a, I think I'm in a break even or maybe a slight profit in RIVN. And think about this also. You have a lot of flexibility if you have a bigger capital. So if you have only $2,000 or $5,000, then you don't have a flexibility. If you have a bigger capital, you have a lot of flexibility. It's like you can pull this bazooka, you can pull that, you can buy 100 shares here, 200 shares there, and add to your position. So you don't have to buy calls all the time. And so if it's turning around, maybe buy a few hundred shares. So RIVN, we are long right now. Next one is CVS. So CVS has a support at 81. So quick profit, 35% gain, knowing that we are entering at 83, 81 is the target. So from $2 quick move, it started to break down here. I entered, actually, I'm late one day in a CVS. I was watching the support level around 84, 85, but then once it broke in, entered for 2 point. So 2 point gains in have to be very precise also in exit. When you have a less potential, then you have to be very precise. Have to monitor the trade very closely, because if the meat is less, you have to be more agile. So 81 was the target. I exited at 81.50 to capture 35% gain. CRM. So this is not a technical skills. This is something got lucky, 100% gain. CRM came on earning. So CRM, we entered here, and it just dwindled for 10 days. So it just going up and down, up and down, up and down. Suddenly it moved up. So when it moved up, went to 193.80 during pre-market hours or after market hours. So that was the line, 194. When the 194, when the market opened, and it did not go above the pre-market hours of 194, 193.80 something. So I sold, majority of them sold, and then I waited for 10-15 minutes, and then it started to move down, so sold the rest. There's a big gap here. So don't want enter here and see all this drawdown, and then it started to suddenly starts to move, and then you give back 100% gain. So take the 100% gain, not good. So these are few charts I prepared today. And here's the slides. And I keep mentioning about Bruce Lee. To practice, like Bruce Lee told one day, to practice one kick 10,000 times, not 10,000 kick one time. So think about it. Are you practicing 10,000 kicks, or are you practicing one kick? And so one kick doesn't mean just one technique. You can have multiple techniques, but gradually you need to master one by one, one by one. Go back and master one, then go back and master second one, and go back and master the third one. So when I was starting my trading, people were trading commodities, futures, and whatnot. So my mentor told me, no, just stick with the stock trading. And then from stock trading, you can do option trading. So here these days, You hear people trading Bitcoin, whatever is hot. Trade Bitcoin, trade this coin, trade that coin, trade all the blockchain related stocks. Make money when everything is looking good, and then lose everything. So, or trade the hot stock of the day, like Tesla. Tesla, in my opinion, have made a lot of losers and winners. It's easy to trade because Tesla, there's something going on. Tesla, you see the cars on the road. Tesla, you see the tweet coming in. The Tesla, there's always a news. You hear some few people making money, and then people open the account and trade Tesla, buy this option, buy that option, weekly option, out of the money option, and okay, everything looking good, and then suddenly everything dies down, and traders wipe out their account. So trading is not making money. Being wealthy is not that kind of a trading. So I don't do any of those kind of trading. So follow the Bruce Lee advice, follow the dinosaurs where the big boys are. So try to figure it out which trade where the big boys are, where they are turning around and coming and buying the stocks or selling it. So figuring it out. So consider them as the dinosaurs. So that's one thing. Another thing is there are millions of chart patterns out there. So don't try to learn the chart pattern. Create this criteria that what kind of chart pattern. If you want to master the chart pattern, then you say, okay, what kind of chart pattern I need to master. So what is my criteria? I mean, there has to be criteria. If you go to buy a car, you have some criteria. If you're buying a house, you have some criteria. When you do the grocery, you have some criteria. Why you're buying certain things? Why did you go to certain school? Or you have a job? Same way, mastering the key. So some criteria you need to list down. That this is my criteria, and this is what I'm trying to accomplish. So for me, is I need to master those chart patterns which I can read correctly. So if I cannot read correctly, and I figured out, no, I can read this again and again, I'm failing, so I ignore that. I can master the chart pattern very thoroughly, but it only appears once a year. So if it appears only once a year, I may catch it, but maybe that day I was walking the dog and I missed it, or maybe I caught it, but that happened to be a loser. So I waited for 1 year and it turned out to be a loser. So I don't want to master those things which appear once a year. I want to master something which I can uh, practice 10,000 times, do the things 10,000 times. So it's appearing regularly. I can master something which is reliable. So I know that this is easy. I see it and I've seen it before, and it's working again, and it will work again. I feel good. So I need to master only those chart patterns. I master those chart patterns where I see the potential, the reward is there. So I need to master those. I need to master those chart patterns where I know that I am really wrong and I need to exit. So if you list down all the criterias of your mastering, then you focus on those patterns or those indicators, or whatever is your thing, or you have a black box. The black box gives you many kinds of alerts. So you tell the black box, hey, black box, you give me too many alerts, so I don't need this, only need this. So maybe your black box, you can set some criteria, and the black box will start to give you only um, those kind of alerts which you like. So you can do that. Also, you can feed. So there are 8,000 stocks in the market. So we cannot trade 8,000. All we need is a one stock per day. That's the maximum. That's the not the maximum, but that's the minimum we required. Let's say one trade, or either on the long side or the short side, or both long and short. So how do you do that? 8,000 stocks. So you need to do some work. So I do the work, and I've done the work. So initially it requires a lot of work for setting up. It's like a foundation. You set it up, then it becomes little easier. So for me, it's little easier now because the work has been done long time ago. I just add and subtract from time to time. So the way I do is I have 165 or 167 stocks, which is the must stock. So I wash them all the time, every day. So those are Apple, Baba, Baidu, Google, these kind of stocks, Amazon, Tesla, Home Depot, Caterpillar, Burlington, those who moves. So what's the criteria? The criteria is the minimum volume. So at least 500,000 volume, optionable. The spread is tight. There is a high beta stock. They move more compared to the market. There's always some news coming in. And then I have a history. So if I'm trading, I have a history of those symbols, which I'm trading frequently. So if I'm trading frequently, I have a history of my performance also, and I'm trading, so that those stocks go into that hardcore stock. So overnight, over the time, I build those the stocks. So there are about 165 stocks. So you can build those stocks like McDonald, um, or United Steels or Mosaic. So those are hard stock or some energy stock. So take some stock from all the sectors, industry group. So you do the study of all the sectors, then you go study all the industry group in that sector, and then you pick one or two of all the stocks. So have stocks related to gold, silver, oil, technology, financial, the home builders, and whatnot. So the industry group. So if you pick 4 or 5 stocks, you have 160 stocks. Some sectors or some industry group have a higher number of stocks. For instance, the energy. So energy, I have more. I don't think I have any other sector where I have more stock than energy stock. So energy stocks, the internet stocks. So Amazon, Facebook. Uh, Meta, AI. So any hot stocks which is being traded, Riot, Mara, AI, anything which shows up and you add it into your hardcore, and later if you think no, this is not a hardcore, right? I cannot trade or it's not good, so you just remove it. So you have to do the uh, homework on uh, such stocks. Then I have core stocks. So there are 500 stocks in S&P. There are let's say 2,000 stocks in Russell. Then there are 100 Nasdaq 100 stocks. Then there are Dow Jones 30 stocks. So I took some stock from here, some from here, some from this indices, and then I combined them. Then I said, okay, I call it core stock. So every day I need to know where they are, which one is affecting the market, which one is going up, which one going down. So I prepared those stocks, so 250 stocks. So went into all indices and then extracted. Non-core stocks, so they are part of the indices, so I keep them in the basket, but I'm not trading them because they're not always. The spread is wide and the volume is low and kind of boring, but and they are there. They are in the indices, so I don't need to trade them, but I need to know them. The small cap stocks, this basket fluctuate. So I do the fundamental analysis. So you need to trade a small scale, you need to do the fundamental analysis on it and then apply the technical. If we don't do that, we have a chance of losing fast. So I don't put all my money or a basket, some portion into small cap. We can trade a lot into small cap because they can make money and we can wipe out our portfolio. It's not good. So just a small portion into small cap. Indices ETF. So we need to know all the indices. If we don't know the indices, ETF, the cash market, the future, we cannot trade the market. So I don't know how people can do that. So we need to focus on the indices. So prepare the list of all the indices ETF and only trade the liquid ETF. I don't trade all the other I don't trade the hundreds of ETFs. I don't trade. It's not advisable to trade all the ETFs. So it's not good. Only the most liquid ones. So the ETF representing some kind of a broad market. So I trade those gold and silver ETF. So anytime if the news comes out, the gold and silver moving, so I immediately have a basket and I can look at my gold stock and I say, okay, out of all this, which one is looking good? So I can do that. So this is a basket of stocks. And before we talked about the charts, so if I take this basket of stock and then I'm looking for these charts, the patterns, I will get something. maybe on the downside, maybe on the upside. Then I apply also the market conditions. So sometimes market is moving up nicely, sometimes the market is moving down nicely, sometimes the market is choppy. So when the market is choppy, when there's no strength, then some stocks are moving up, some stocks are moving down. So then out of 500 or 800 stocks you have, 2 or 3 are really good to trade to the short side, and 2, 3 are really good to trade to the downside. So we have to balance it out. So then if you have a trading system, you can apply the trading system on this basket of stocks, and the trading system is telling you the kind of chart you're looking for, and you select that symbol. Once you select that symbol, then you need to apply the trading strategy. So in other words, you do the homework for the stocks, you master all the chart patterns, you have your trading system, then you study the market based on the market conditions. Then you say, okay, today is the day, or for the next 1 week I need to trade the short side, or I need to trade to the long side, or I need to trade both sides because the market is in between. So, and then when you get the symbol, then what strategy you need to apply. Are you buying calls, or you're selling? You can buy calls, or you can sell puts, or you can create a spread, or you can buy shares, or maybe you can do some other stuff. So whatever you need to do. Maybe you're only good in trading to the long side. You don't trade to the short side. So you need to have an inverse ETF basket. So inverse ETF baskets, they go down or up uh, the other way. So if the market is going up, they are going down. So if you're good in trading to the short side, you can you can so when the market is going up, these inverse ETF are going down. So if you're good in the shorting side, then you can short the ETF. If the market is going down, these ETFs are going up. And if you have one trading system which tells you, or you're good at detecting the long side, then you just trade the inverse ETF. So inverse ETF, so in other words, you're just trading on the one side of the market. So if you're trading just through ETF. So trading only one side of the market is not good. Trading on the both sides is good. So you lose your edge if you don't trade on both sides of the market. Market is 70% of the time market is choppy and moving nowhere. 30% of the time market is trending to the upside or downside. So if you don't master both sides, what happened? You miss out that 70% of the time, because 70% of the time market is just choppy, and there are very few symbols which are going up or down. So the 30% remaining, and then if you don't master the downside, then maybe 15% of the time the market is really going up. In other words, in the 1 year, you're making money only those 15% of the time, and 85% of the time you need to be out. But since we don't want to be out, we constantly want to be involved, so we are losing money in those 85%. So even in a choppy market, there's some stocks which are going down, really going down. So you're on the lookout. And even on the choppy market, some stocks are really moving up. So we need to master both sides, short and long side. Prepare the baskets, understand what we are looking for, and then understand what kind of a strategy we will employ, understand what kind of portfolio we have, understand who we are. So this is another problem. We don't know who we are. We just try to make money from the market. So price discovery. So this is the step. The first step, price discovery, is through the black box. So the black box tells you whether the stock is going up or down. Maybe it gives you green arrow, maybe it gives you the red arrow. So look for those green arrow and red arrow, but make sure that you're looking at the proper time frame. So if you are a swing trader, maybe you're looking at the hourly chart, not at the 5-minute chart. So make sure the green arrow and the red arrow is coming up at the proper time interval, and the arrows which are coming, they are also aligned with the other higher time frame. So the market can be going down on an hourly chart, but is actually moving up on a daily chart or a weekly chart or monthly chart. So the trend is against you, and then you have a higher chance of losing in that trade. So if you're trading the black box, make sure you understand that black box. if you have mastered the chart patterns, so understand your chart patterns, just limited chart pattern, not thousands of things. Band trading, people do band trading. They trade when the stock is touching the lower line of the band, they go long, assuming that, okay, this is the lower level, and then the market goes up. When it goes to the top of the band, they short, assuming the market will pull back to the lower line of the band. So if you're that kind of trader, you can do that. I'm not band trading. Trend trading, I am a trend trader. It's very important. Um, so recognizing the trend, the detection of the trend is very important. So this is where the money is, where we detect the trend early on, that this trend is changing now, is no more, it's going down now. It has reached some kind of a support level and market is about to turn upward, or it has reached some kind of resistance and the market is about to pull back. So trading combined with the support and resistance is an edge. So trend trading, recognizing the trend and then recognizing the support and resistance. So support and resistance, this is, in the other words for support and resistance, is buyer and seller, or demand zone or supply zone. So there are many names: some demand zone, supply zone, buyers, sellers. So I pay a lot of attention on the support and resistance, because this is where the support and resistance mean this is where the battle has been fought before. So it's like you're reading, if you're trading a stock which is traveling in an uncharted territory. So I give you example, like it's hard to trade CRM right now. It gapped up huge, so very hard. Moss is moving up. It's a hard trade. The trade which are easier are the trade which are trading in a previous zone, a previous landscape. The trade which are trading beyond the previous landscape is hard to read. We fail to understand where it can go and what is the target. We don't understand the target. We can't measure the target because it's trading in a uncharted territory. But if the symbol is within the previous landscape, then we can go on an hourly chart, or go on a weekly chart, go on a monthly chart, take all the help we can from all kinds of time frame to figure it out where all the twists and turns are, and we can draw the line, horizontal line, trend line, etc., to tell us where the support and resistance, and then we can make some decision. So support and resistance, I pay a lot of attention, and then I also try to understand what kind of support and resistance. Is it a weak support, or very strong support, or a weak resistance or very strong resistance? And then what is doing at that time when the stock is approaching that support or resistance? So it tells you something is about to occur at support or resistance, and then you become like a cheetah, sitting by the well, knowing this is the support or this is the resistance, and you're sitting on like a cheetah near the well, that and like a hawk or an eagle or something, that you say, okay, this is what I expect. Let's see if it's happening, and if it's not, then it's telling you that you are wrong, and the stock is doing the other way around. So you are fine with that too. So support and resistance, combine it with the trend trading, and then if you can read the charts, so chart, support and resistance, and the trend. So detect the trend. So detect the trend in the early phases. Not anybody can see the chart long. This is, oh, this, look at this trend is going up. I see higher and higher low. This one is trending. So it's easier, but early detection is hard. So try to master early detection. Breakout when something is moving beyond the resistance. So there was a strong resistance, the stock is breaking out, or stock is making a 52-week high, or some kind, whatever number of days you have, and it's breaking out with the volume, breaking down, breaking the support. So breaking down, it can break down below the resistance. Sometimes the stock move above the resistance, and it makes us uh, like fool us. So there's a strong resistance and it goes beyond the resistance level, and then it pulls back. So it pulls back. And so the sellers were there, they sold everything, and temporarily that day the market broke the resistance, and by the time the day ended, it closed below the resistance. So now the market closed below the resistance, and if you are watching, what's the next step? So the next step is the next day. So next day, if that resistance is really valid, the next day the market needs to some kind of a sharp decline or a gap down. So then we have a clear-cut resistance level on the top, and we know the resistance is valid, and now the market has started to fall apart. So that is a breakdown trade. Gap up, I trade gap up. I'm looking, when I'm trading gap up, I'm looking for the gap up above the resistance. So if there is a resistance clearly cut, I've read it before, or when the market is gapping up, then I try to read the resistance level. For me, gap up above the resistance level. So it's like a river. I keep giving you example of a river. So there's a river and you are on this side, and it's like a dog is chasing you and you reach the river, and the river is wild. So one option you have is swim in the river, but there are alligators and all that animals there inside, and the dog can chase you. He can swim and then he can go in the river and bring you back. So or the guys are there and they're shooting at you and you die in the river. So all that. So that's what happened when there is a resistance level, a channel defined, and the stock is trading in that channel, which is a resistance zone. So a lot of buyers and sellers, they die in that channel. They don't understand why it's happening. But and even though the market has gapped up, so it's like you jump in the river 10 feet, you're a good jumper, you jump 10 feet. But imagine this, if you reach the river and you get the magic carpet, and then you sit on the magic carpet and then you flew on the other side. The river is so wide, and then you flew on the other side. On the other side, the dog is on this side and he's just looking at you, and the guys are just standing there with their bullets, with their guns, and they're firing at you, and you are beyond their reach. So that kind of a gap, when I recognize that kind of gap, that's where I know now, okay, this gap is. So when I cross the river with the magic, I better not the magic carpet. The magic carpet should not turn around and take me to the other side of the river. It shouldn't happen like that. So same way, if the market gapped up beyond the resistance zone, it should stay on that zone, the upper line of the resistance line. So think about it. If the resistance is a channel, then if the market gaps up, it should stay on the other side. It should not. If it comes back in the channel, it should reverse upward fast. So you say, oh, no, 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 don't go down. Bad guys there, reverse, and then it reverse. So the volume, etc. So that's what happened to CRM. So CRM gapped up above the territory, and it was hard. 194. I was watching the aftermarket hours. I was watching the pre-market hours, as I knew 194 is the if it's trading at 194 in the pre-market hours, when it gaps up, it needs to immediately go above 194, and 190 was like a line in the sand for me. So I drew 194 above and 190 below, and then it started to reverse. So it's like um, the sitting on a magic carpet and going on the other side, and then reversing back in the river. And then I don't know how far the pullback could be, and I end up back to the other side of the river where the bad guys are. So better to lock the gains of 100%. So when I'm sure the gap will be on the other side of the resistance, then I initiate a long position. And if I am in the trade already, then add more to the position as if it's a new trade. So if you're already in the trade and it gaps up and you're holding that gap, and it goes on the other side and you're holding it, you're long. So you may want to think about it. Okay, it gapped up and this looks good. You don't have to add to the same strike. You can add another strike. You can add, if you're holding 30 strike and it gaps to 34 or something, then you may want to add a 35 strike. And you have 30 in the profit, and then you add 35 strike. Maybe you can sell the 30 strike which you have profit and see how much profit you have. Maybe you can buy double your contracts. the 35 strike. So if you, let's say, you had one contract and you are up $600, and then you look at the strike out of the money, and it's trading at $300, $3 per contract. Maybe you sold that one, which you made money, is in the money, one strike for $600 profit, and then you add two more with the profit you got out of the money. Now that new out of the money trade is free, is from the house money. So you're trading for free. You locked your gains and took that gain and bought the out of the money strike. Why? Because the market gapped up, and it gapped up on the other side of the resistance. So now you're trading with the free money. You don't have your own money involved. So that's gap down, gap up. Gap down is when the stock gap down. So a lot of stocks gap down. I don't pay attention to all, but then there are some meaningful gap. So sudden break, there's a congestion, and then sudden break. So sudden break is very important for the gap down. Suddenly the market gap down and there's a huge volume, and the gap down is from the get-go, like from the early morning. It just can't wait. So it happened to RIVN and low, etc. So usually there's an event and which triggers that gap down, and the gap down occurs from the congestion zone. So the stock was just trading up and down, up and down, up and down. It looks like it's going to go up. It's building the support, and then the news comes, and then it suddenly gaps down. So that sudden gap down gives us the opportunity. Another one, I trade gap up reversal. So I don't trade this much, but gap up reversal. So this gap up reversal, just like trading the gap up when it goes beyond the resistance. So gap up reversal is when, let's say, you you're riding the magic carpet, and the magic carpet just falls in the river. It didn't cross beyond the river, so it just fell in the river, and now you're in trouble. So that's where the resistance, the sellers are sitting in that zone. So that's where the stock starts to reverse sharply after gapping up. So if you recognize the gap has occurred on the resistance zone, and now it starts to fall. So Baba did that 2 days ago, or yesterday, or 2 days ago. Baba did that. It gapped up to the resistance and it's falling. So if that happened, then you can add to you can initiate a short position. But this one is very tricky because the market is gapping up, and then so when the market gaps up, we think, okay, it's going to go up, but it's reversing sharply. So it requires agility, very quick detection, and then taking action. Gap down reversal, usually the gap down reversal, if it happens to 50-day moving average or some support level or some support zone, and a 200-day moving average, and it's just continuously moving up after gapping down, then it's a trade I take. Not all the time, but sometimes when the stock gaps down to, let's say, the example was Intel. So Intel gap down to 25 or something, and then it starts to move up, up, up. That's where we went long. So gap down to some levels which you can read correctly. Gap down where you can read correctly, and then the intraday chart, 15-minute, 30-minute, all building the bars to the upside. There's a tick, tick, tuck, tuck, tuck kind of movement, there's constant move to the upside. So that's the gap down reversal. I like the intraday reversal. So this is one of my favorite intraday reversal, along with the trend trading and support and resistance. So trend trading, support and resistance in the breakout, and the intraday reversal. Intraday reversal comes into play when the stock just keep going down. Let's say, giving example of a long, this is starts to go down, down, and then the market was going down, and then the news come, overall market. So the news comes, overall market, the market turned green. So you need to know the market is turning green. Most of the stocks are moving up towards, pulling back up. So the stock which you were watching for reversal, and it starts to happen intraday. So your risk is below the low of the that day, or maybe 1 or 2 days low, which was created recently. So intraday reversal can play a big profit, especially if you have a position and it's going down and it hits some kind of support, or in the market news comes. So there was nothing wrong with the stock. It's just that the overall market was down, and now it's reversing to the upside. So if you can catch intraday reversal. Moving averages breakout, I don't trade moving averages because there are so many lines on the chart. If there are 365 traders, then there are 365 moving averages. So you can put 20 moving averages, just a line. You're drawing 20-day, 21-day, 50-day, 200-day. So as many traders as there are moving averages. You can have simple moving average, exponential moving average, and adaptive moving average, and a weighted moving average. All kinds of moving averages you can have. So if you are good in a moving average breakout trade, I don't do that. Filters. So then so many stocks are coming up on your screen. So define some kind of a filter that this is the minimum requirement. Like this is my minimum requirement. Volume needs to be, let's say, at least right now and during the first hour, 40-50% of its normal volume for the day. You can do that. Price, it needs to be up at least maybe 0.5% or 1% or something, some kind of a filter. If you're trading for swing, maybe the minimum requirement for the price is $20 and above. I don't want to trade $5-6, but I've seen. So you can have that filter, or you can say, no, I can trade $5-6 stock. They move good, like Riot, etc. So they are small cap. So just remember, but need to have some kind of a price filter. If you're trading a small price stocks, $3-4, and buying long calls, maybe you can do that. But for the puts, if you're buying puts on a $3 stock, what do you expect? Where is it going? It will go maybe to $2.60, etc. So on the short side, the small price stocks, not good. Average true range filter. So if the stock on average moves, including its gap up and gap down, if the stock moves, let's say $3, and it has already moved $2, maybe you can put the filter to show you the stock which have moved, let's say 70% or 80% of their true range is moving abruptly. So there's some abruptness going on. There's some urgency there. So you can set some filters based on average true range to define the urgency. There is some urgency in that stock. Somebody is buying it at urgent basis. So the volume, the price, the true range, you're capturing. I don't base my decision on sudden spike in volume. If I'm already in the trade, then okay, it's fine. I can look at it. Oh, there's a spike in the volume. So a spike in volume does not generate any trade for me. I don't decide the sudden spike, because sudden spike, what on a 1-minute chart, I see a long bar. What does it mean for me? I don't know. So overall volume. So the no is not for me, not a spike. If I'm already in the trade and the volume is there, spike 1-minute chart, okay, or 5-minute chart is good to know, but not some criteria for decision making. Sudden move in price. So there are 500 stocks. Let's say you're watching 200 stocks. So some kind of a filter for you, which tells you that there is a sudden move in this symbol, whether it's an open position. So you have a basket of open position. You're putting the filters on that open position in a separate basket, and then this price filter, sudden move in your watch list. So you have two baskets. Now you have open position, and maybe you can have a multiple basket for open position, one for the short side, one for the long side. You can have another basket, one for the long side, one for the short side, and one for where you don't have a option position. You have only the shares. You're buying the shares. So you're long or short in the shares. So you can have a multiple baskets for your open position. But then there is a watch list. So the filters for the price on your watch list. So if there are 200 stocks during the day and they are all moving up and down, I start collecting. Like I go, it's like when you there is a mountain here, and then during September, October, I take my children for apple picking or strawberry, etc. So you go and you pick the apples. So it's like this, 200 stocks moving. I cannot watch all 200. So I say, okay, this one, I extract that one, that apple, and put it in this basket. This apple goes in this basket. And then as the day is going by, my basket is growing, or maybe it depends on the day. I have a long basket and I have a short basket. And it also tells me which side of the market is tilting. Like today, my basket, I did not see anything for the short. All I saw was the long. Whereas 3-4 days ago, all I saw was like a few stock, Moss or something else, LNG. Other than that, they were all coming up in the short side. So I was paying more attention to the short side. So sudden move in the price can tell you that something is going on and you need to look at it, especially if you have an open position. And then you need to have an alert system. So a trigger. So do you have all the alert system to trigger, to give you the alert on your phone or on your monitor or pop up or a bell that this is what's happening? So set up the alert system. So I set up a lot of alerts. All day long I'm getting alert, but all the important alerts. So these are some of the important alerts I have, like opening range breakout alert. So you can set the opening range breakout, meaning if the stock has made a new high after 15 minutes of the market open, or after 30 minutes of market open, or after 60 minutes of market open, give me the alert. So as the market is moving, I'm setting these alert and I get the alert. So I know, oh, Twilio has made a new high right now. Meta has made a new high, or this stock has made a new low, or what else is going on? It's approaching my target. It's only 0.5% away from my target. I need to start paying attention because it's approaching only 0.5% away. I need to pay attention. I need to transfer that symbol into my detail monitoring. So I need to have a workspace open where this symbol goes, because now is approaching a level where I need to take some action. So the exit protocol may trigger. I need to take some action. So that symbol goes into that basket. So opening range breakout, the time filter you can define, 15 minute, 30 minute, or hourly. So note down the new high. A 15-minute window means a new high is made. So let's say, give you the example, if let's say the market opened and like FSLR today. So FSLR was on my watch list, and as soon as the market opened, it's just popped up and it's just moving, a sudden move at a 200 level. So I started watching 5 minute, 10 minute, and it started to make a new high, quick. It moves big, like 40 cents, 50 cents. So my order was ready on my phone. So my orders are placed on my iPhone. My order is ready, and I see a jump in the FSLR, and it's making a new high after every 5 minutes. So that was the indication that something is going on with the FSLR is there. So you can do that. The gardener is here. It's Friday and the gardener is busy. I'm sorry. So you hear the gardener trimming the trees. So now another alert you can make is a new intraday high. So if let's say right now I don't know what's going on with the market, I'm not watching. So let's say it's about 11, new intraday high being made in certain stocks. So you can set the alert, or new intraday low made. Percentage up, you can set the alert for 2%, 3%, or 1%. So at least you pay attention to that. Percentage down, how many percent down? 3% down, something is going on with my puts. So maybe it's time to take profit. Volume 30% of normal. If it's trade 1 million and it's already 30 minutes gone by, and you got the alert at 30% of the normal volume, then pay attention to that stock. It's only half an hour and already trading 30% of its normal volume. So normal volume, you define what's the period. Is it, do you take it a 10-day average, or 14-day average, or a 30-day average? So you define what is normal for you. I do the relative volume. So another thing is relative volume. So you can do the relative volume analysis that on this time period, if it's moving if on a day, if the stock moves 1 million. So if a stock moves 1 million shares per day on average, and at any given time period, let's say 35 minutes gone by, if there are 390 minutes in a day. So if trades 1 million on a day, which is 390 minutes, so on average on a 35-minute, how much you expect the volume in that stock? And if it's above that your expectation, maybe you need to pay attention, especially if you are in that trade, open trade. So let's say you are long on Airbnb, or you're long CRM, or you're long in this, and then the stock is moving at a high volume, then you're taking help. So knowing the volume is very important. I don't chase the volume, so I'm not a volume chaser. That the volume is so good, because when the volume, it actually, um, you need, when the volume is extremely high, you need to start to look at the volume is extremely high. The price is also moving. If there is any anomaly there, so if there is an anomaly, the volume is high and the price is not moving, there is an anomaly. So you need to pay attention to all the anomalies. If the volume is high and the price is difference is low, there is an anomaly, because the volume is so high, the stock did not move much down, so must be something going on. So if the volume is high and the price is high, that's it's considered normal. So if the volume bars are normal, if you look at the chart and the prices are moving, the bars are proper compared to the volume, then it's a normal move. If the volume is big and the bars are small, everything is getting to the downside, that stock, the distribution is getting absorbed. So somebody is accumulating that stock. So constant analysis of the volume, the relative volume, and all the anomalies is very important. So pay attention to all the anomalies. Maybe you can rate your volume. So I do rate, all the volumes are rated. So I rate above average volume or whatever it is. When the volume is big, huge, and the stock is breaking above the resistance, I pay attention. When the stock is breaking the support, what's the volume? I pay attention. If the volume is low and I expected that the stock is breaking the support, and the volume should pick up, but it's not. So I'm on the lookout to close the trade at break even. So today I closed a WDC trade. I had a put trade and just break even, I close it. So break even trade is a winner trade. So always be on the lookout to close the trade at a break even if you can. Sharp reversal from resistance. If you understand the clear resistance, and then so you define the alert on the resistance. So if the resistance is there and you define the resistance and you have some alert, and then it hits and then reversing sharply to the downside, you should be able to get the alert. If not, then you're missing out on that short trade, or you're missing out completely on your profit taking, because when the resistance is hit and you don't define the resistance, and when there's no mechanism for your alert, then you miss out in taking profits. So develop the system to give you the alert when the sharp reversal move is happening from the resistance. Similarly, sharp reversals from support. So all these alerts needs to be set. Crossing moving average from below. So some stocks crossing from below above the 50-day moving average, or crossing below from below above the 200-day moving average. So knowing is good. So it's like you understand that the stock is doing this. So because some some traders pay attention to these moving average. So if others are paying attention, you're not deciding based on that, but if somebody else is paying attention, then you need to pay attention. So there is a wisdom in following the crowd, or understanding what the crowd is thinking. So there is always something which you need to look at, what the crowd is looking at. So figure it out what the crowd looks at. You also look at the crowd. Like for instance, I come at nighttime, I drive home and I see all the cars parked, lined up on the other side. And then I go and I'm the only one and I park on this side. I'm the one who's getting the tickets, because all the other cars, they knew that they are supposed to park on the other side. And now she just say, oh, all these guys are, I don't know why they park on the other side. They left this car space for me on this side. Okay, I'm going to park the car here. And then I park and I get the ticket. Similarly, all the parking spaces are there available, packed on the beach, and there's only one spot there available. And you say, wow, I'm so lucky. I park the car here. And then you go and park there. So I park the car there. It happened to me in Huntington Beach. I parked the car and I came after the evening, and I have a ticket. So this ticket, I get the ticket. I forget to notice the fire hydrant. So when I come back, I get the ticket. It says park in front of fire hydrant. That's why nobody was parking in this spot. So same way, Even though you don't need to make the decision, but you need to watch the thing which other traders are watching. So there is something wisdom in the for following the crowd. It doesn't mean the crowd is always right, but pay attention to what the crowd is also doing. So let's say, so after do all this. So now you say, Nashi, you do a lot of work. So yes, I do a lot of work. That's what I do. So I'm very passionate. So let's say I trigger something happen on my screen, a monitor in the monitor. So I am long on my meta calls. So let's say meta triggered. So Meta triggered, and let's say it's a month of October or yeah, month of October right now. So I send you this alert, December, buy 130 calls at $10, and in the email it will explain the stock is Meta, month of December, strike is 130, type call, and your action, what action you need to take, buy to open. So when we buy calls, we say buying to open. When we sell the calls, we sell to close. So these are the two. Normally, traders who are long, they execute this order, buy to open, then sell to close. You can sell to open and buy to close, but that's a different thing. But here is buying to open. So you're opening a trade and you buy it. When we close it, we say sell to close. So suggested price is given $10, and you can pay $10, 20 cents, 30 cents, etc. And we always buy third Friday expiry option. So we need to buy those options which are standard. If we tend to buy non-standard options where the most of the guys are not trading, we tend to lose, because each option contract carries 100 shares. So non-standard could be 125 shares or 150 shares. So if you're not aware of, you can make a lot of mistakes. So always try to buy the standard. So, and it's expiring third Friday expiry option. So it's by default, so third Friday expiry option. I send you just little subject line via email and SMS, and in the email is this. There is no, if I have to write something, I write in caps. So I prefer writing in caps so that I don't make a mistake. I don't like to, when I'm sending a quick message, I don't want to write beautiful. So my purpose is not to write in beautiful language. I try not to be a poet or a philosopher when I'm composing a trade. I just send you the thing which you just need to act. I know you're busy, so I just compose a little line and I send. If I have something to say, I say it quickly, that what I'm looking at, and then later I can explain. So I do that. After I do this, then your job is to execute the trade on your phone. So these days you can really execute your trade on your phone if you're not watching the charts. You just follow the trade alert. So put the alert on a limit order. Always buy at the limit, not at the market. You get fill at the wrong price. So you don't want to do that. Market price means market maker. I'm greedy person and I want to buy this. I'm in a hurry. I want to make some money. Give me this. And then the market maker will give you whatever he thinks, or someone else will fool you. You know, they will come and come in front of you and give you the worst price. So you put your limit, that this is my limit. Not to limit means not to exceed the price. So you're telling me, hey, not to exceed this, $10 is my limit, not to exceed. So you put that, so you get it. If you don't get it, it's okay. Then you can decide. Sorry, the ball is in your court. So if you want to buy 3 contract and you got 2, it's okay. You know, you don't need to buy all 3. You just cancel it. Don't buy the third one at the higher price. You can always buy at the lower price. You can put that money into another trade. So just don't get filled. Need to get filled all 3. If it doesn't fill, it should get filled because these are liquid. If it doesn't, then you just cancel it. Don't buy at the market price. And then when you receive the alert for the targets, then you can compare how much potential it has. So I provide you 3 targets: green, yellow, and red. So always uh, when you're trading, you need to pay attention to where is your position and how much target is left, how much potential is left, and then compare what you will be giving back if you don't take the profit now compared to taking the profit later. So if, let's say, I'm giving example, let's say you're in the trade and the target is 57 and the trade is at 56.50. and it's only 15 minutes left in the market close. So you say, okay, I hold it, target not hit. Right now it's 56.50 and the target is 57, but there's a weekend there, and if you don't take, maybe something happened, pull back. So so you it's a tough decision to decide how much you're leaving if you don't take the profit right now and the time is against you. So when I send you the alert for the targets, you can look at it, the yellow target, which is the middle target, and then compare if it is still worthwhile to go for that trade. Shave the spread, meaning your if the bid is 940 and the ask is 10, maybe you can, so the midpoint is what? Midpoint is 970 or something. So don't just calculate the mid price, although I calculate the mid price. So when I'm buying, I just give some towards the uh, the market maker. So if the mid price comes to 970, maybe you can put your order at 975 or 980 and you will get fill. So you will get fill if you shave the spread and leave it there. So limit order, use intelligently. And then there is a chart here. I put it and I explain in my email, in my guidebook, that what you can pay. If you're buying an option which is 70 cents, maybe you can pay 75 cents. Or if you're buying an option at $12, which is $12, which requires a big portfolio, maybe you can, for instance, the Tesla. Maybe you can pay 50 cents more if it's moving, and then you think it may slip away. So instead of buying 2 contracts, you end up buying 1 and paid extra $12.50. Then the second one should be at below the $12 original price. So your average comes to $12.05. So you need to manage this, how much extra you are willing to pay. So depending on what the stock is doing at that time, depending upon when you open the alert, depending upon where the targets are. So all this work, I mean, you have to read something. So don't be over anxious, don't pay extra, it's your bid. Sometimes the stocks just initially burst and then it subside. So during that subside period, you will get fill. So watch the lower level chart while your order is there, open in the market. On one hand, you're watching your open order, and on the other hand, you're watching the lower level time frame, such as 3-minute or 5-minute time frame on the chart, and then you are you are synchronizing it. So synchronize your order with the lower level time frame, and then figure it out what you need to do, whether you need to cancel your limit order and raise it, or you are better off leaving the limit order as it is. So leave it for only few good minutes and then cancel if it doesn't get filled. So you need to synchronize your buy order with your charts, where you are making as if you are acting like a cheetah, like a eagle. That's your focus at that time. And then when you get your order filled, you make sure your orders are filled and everything is okay, and then immediately set the sell order for 40%, 50% gain. You never know, maybe in 5 minutes later it gets filled at you're out at 40, 50%. So put some kind of a sell order, good till cancel, which you can cancel anytime, but at least the sell order is there. So put some sell order there, good till cancel. So when, in case you're not watching it, it gets filled and you are out. So do that. Now, after so when the trade is being generated at that time, we should already know where is the risk and where is the reward. It's just that I take a few minutes or an hour to send you the target, fine tuning. Maybe I'm busy doing some other thing, so I send the alert. Now I'm busy doing managing my open position, and I'm doing other thing, and I know what the target is. So the targets are plugged in and send you via email. If not, then you can set 40-50% on average. So the determination of target is a science and art. You have to be you really need to constantly evaluate your targets. So it's like the missile goes and constantly follow where it's supposed to go and hit. It just constantly, if you watch the video, like fighter jets, and the missile is there, and there's a dogfight going on, and then you see how the expert, they avoid getting hit by the missile. So same way, and the missile keeps chasing. So it depends who is the more smart. So same way, you need to constantly evaluate your targets and set it up. So it's like a precision guided missile is following. So do that. So I provide you 3 targets, and there is a reason for you, because some members have a high portfolio size. So I provide you 3 targets, which I call green, yellow, and red, just like the traffic signal. So we can relate. So green target is the first, yellow is the second, red is the third. And the reason green, yellow, and red is uh, some target, they are easy to hit because there is not much distance from your entry. It could be like that, but then you will make less profit, or there is no resistance in between. So the target is such, the first target is such that there is no resistance if we are going long, or there is no support if we are going short. So it's like a clear sailing. So green target, there is a high probability. So it's an immediate target, and there's a very high probability it will hit. So 95% probability of stock hitting the target. So I give you this example of, if I live in San Diego area. So if I am leaving San Diego and I'm going to Seattle, and I did one time, and then I don't know when I arrive. I arrive very after a week or so. So if you're leaving San Diego and going to Seattle, your GPS will say maybe 35 hours. You will arrive in Seattle, but you will not arrive in Seattle 35 hours. You will take so many stops. You will arrive like 1 week later. But if you say GPS says LA, it says 59 minutes. Most likely you will arrive in 59 minutes in just a second. You will arrive in 59 minutes in LA. So that's the concept. And then there is no traffic. So you see it's all blue, there is no red. So you just keep going, and then in 59 minutes you are in LA. So the high probability of green target. But high probability is there, but has to have some kind of a profit. So 35 generally is 35 to 40% profit. If it's a lower price stock, then the percentage is higher. If it's a lower price, if it's a higher price stock, so we are making 300, 400 in a contract, but the percentage is lower. So it all depends on the dollar and the percentage amount. So 95% probability of stock hitting the target, because there is no resistance in between, or there is no support if you are trading puts. So sell 1/3 of your position. So I send you the alert saying sell 1/3, and you can follow it yourself. So if 6 contracts were bought, you sell 2, and you have 4. So if you have 4, you're going for a higher target, most likely red target. Some for yellow, and others are for red. So if you can manage your trade yourself, and you see it clearly that no, I don't need to sell at green, and sometimes I do revise my target and tell you to hold on to it, don't sell. You can hold for the higher target, which is a yellow target, the second target, or the red target. So when that thing happens, when we see there's a potential and the stock is moving fast, I send the alert to hold, don't sell. So you're aware of that. I don't need to sell at green target, and I need to sell at yellow or red. Generally, sell 1/3. The yellow target is the second target, which means there is some kind of resistance. So if I'm going from San Diego, San Francisco is my yellow target. So I will get no matter how much I say that I am going for Seattle, and I've been to San Francisco 10,000 times, and I don't need to see the Golden Gate Bridge. I don't need to stay in San Francisco, but I will not listen. I will stay there, and then I will travel. So same way, there is some kind of attraction there, some kind of if it's a long position, some kind of sellers are there, some kind of resistance there, and the stock may stop for a while, maybe 1 day, 2 day, and then it moves up, or it may just come pull back. So the yellow target is based on that kind of a reading. So some kind of a resistance, some kind of a pit stop. So when the yellow target is approaching or hitting, I send you the alert to sell half or sell majority, depending on how intensive the yellow target is. If the yellow target is very intensive, the resistance there or some other factors are there in the market, because there could be many variables which triggers your exit protocol. So there could be other exit protocol, just not the target. So if that all are converging, all reasons are converging for you to take the profit, then you exit from the yellow target. So there are many other exit protocols, not just the price target. And so all of them are converging. It's getting more intensive to exit, sell majority of it. If it's not, then sell half. So I do send you. So think about it. I'm sending you alert to sell half. Let's say based on my thinking. What's I'm thinking. What else is going on in my life, or what else is going on in my portfolio. So I'm sending you the alert. I don't know. There are thousands of members. I don't know what else is going on with John and what is going on with Tom. I don't know. John and Tom, they are two different persons. John goes and sell all. Tom says, I will sell half. So I don't know. Maybe one person have a $2,000 portfolio, another one has $1,000,000. I don't know. He has 10 position, another one just started. He started yesterday, and that's his first trade, and it's hitting yellow. So maybe he wants to hold. So there's so many variables. So you know better what to do with this trade when I send you the alert to sell half or sell majority. So after we send when we sell at some major resistance, like when we reach San Francisco and we are selling majority, then we know we have little bit left. So what to do with the little bit left? Is it, if it's a stock, we hold it, there's no time decay, but then there is an opportunity cost. But if it's an option, then option, if you look at the option price, um, if the stock hits, let's say 100 target, and you sell your option at $12, even if it is staying at 100 tomorrow, the option will not be selling at 12. It will be selling at 10-20 cents less because of time decay and volatility and whatnot. So there is always, the stock has to compensate for each day of loss in the option premium. The stock has to, someone has to compensate for it, either the volatility in the stock or the stock itself, something happening which is positive, more positive compared to the time decay in the option premium. So you have to balance it out and see what is more favorable in your situation. Is it the time decay is running against you more, and you expect more from the stock volatility, or the stock have a higher target? So there is a balance there. And if the stock stays for 1 or 2 days in the same position, nothing else change. If nothing else change, all the variables are same, the option premium is less. So if that is happening, and then another trade is developing, then I send the alert to sell the rest and close the trade. Or what if the market is just about to tank? I mean, it's just something coming up, or some major event is about to occur, or some new. So it's like new horse. So you see the new horse, you say, okay, I'm gonna bet this new horse. I don't have much money. I cannot just keep the position. I'm selling the rest and initiate a new trade. So it depends. So we do send you the alert, sell rest. Now the red target. So this is where the red target is very tricky. So red target is the ultimate target. It's like a big resistance level over there. So and it has a less probability, but when it's hitting, it's giving you a lot of percentage gains or the dollar amount. So and then some event is occurring. So when the event occurs and it goes beyond the red, like Airbnb, or there was another one, I forgot the symbol. So many, I just forget. I forget. I really forget. What? Which one was it? So I have to look at my books. So I forgot Airbnb, and then there was someone else, and then the recent is I'm forgetting. It's Roku, not Roku. CRM. Yeah, it was Roku, I think. So Airbnb, Roku, and then yesterday was CRM. So CRM, let's say the red target was one. We entered, let's say, at 164, 165, and then we got lucky. Our red target was 175, and then come earning, and then it goes to 190, 87. It opened at 187 after hours, or 185. It opened at 185. It started trading, and I said, oh, 185. Let me see my revised target. So I revised it to 187. I'm constantly revising after hours. And then I see, okay, 187, 189. If it stays at 187, 89, I will lock the profit. Then I see 189 breaking. I say, okay, 189 broken. Now what's next? Then it's going to 191, 192. So I say, okay, now it's just flying. I don't know where it will end. So let it go. And then it ended at 194, let's say. So now my ultimate target is beyond the red target, which was 175, and now it's 194. Now my job becomes very hard. That do I hold it right after the gap when it open, market open? And not only that, when the market opens, the market maker knows that this stock is gapping and there is a demand or whatever it is. He has to balance his book. So he's balancing his book, but the option guy, he's not opening the option because he cannot open because he has to balance his book. So he's allowed to hold the option market. So if you look at the option chain where CRM is trading at 194, and you look at your option is trading, it's not open, it's previous day price. So now you are at the mercy. You're saying, oh my God, CRM is pulling back. It was hit 194, now it's 192, and the option is not trading. And when it's gonna trade? And then it trades, and it's not 24.50, and the bid is $1 difference. So now, if you bought at $6 and the ask is at 24 and the bid is 23, $1 difference. So in my opinion, you shouldn't be haggling over the bid and ask in between, because think about it. Yesterday you were buying at 6, you bought at 6. Today at 24 at ask, and the bid is 23. There is a $1 spread, and now you want to haggle over the bid and ask. If you want to get out, you get out at the best price available, the first best price available. So now your job is to watch the option chain, see if it's normal, your order screen, and then on the other side, you're watching your 5-minute, 3-minute chart to make the decision whether to hold or to sell. And then on top of that, I have to send you the email. So I have one monitor to compose the email. I have another monitor, I'm watching the chart. Then I have another monitor where order is there to sell. So all this is going on. So I send you the alert to sell rest. If we have not sold, then sell all. So this is what happened. I send you the alert for CRM to sell majority, and then it didn't hold. So it was not holding 192 or 191. I send the alert to sell the rest. So we sold all because it gapped up, and it was not holding the level, the pre-market level. So in other words, as a trader, um, so the option maker, the option specialist, he will open all the months and all the strike one by one. So this is what he will follow. He will take 1 month of options, and then he will open one strike for trading. Then he will open the another strike. We don't see it. If you see, there is a delay in trading, few seconds of delay. He's opening all the strike one by one, and depending on the month. So he opened the current month, one strike, another strike, another strike, another strike. Then he opened the another one, then another strike, another strike. By the time he's done, he opened all the strike to trade and all the month and all the calls and all the puts. And so he is reading where he is. So he is plugging his numbers in his option formula where the option should open for trading. And you are trying to close your position or buy a new one. So there's a lot of going on at in such a kind of situation. So you have to be very agile in such situation. Not only that, if you have a position and you don't know what the high was made during pre-market hours or after market hours, then you're screwed. If CRM made the high in the pre-market at 193.78 and it opened at 193, let's say 50, 60, and it's not going above 193.78 or 80, and you keep holding it, you will lose. So you need to know what's the pre-market level was, what's the after-market level was. So I do that, and you need to do that. So action to take a red target, the stock gapped above red target. It gapped above, way above 135. It, and then a new red target is defined. How we define the new red target? By reading, by various methods, by seeing what's the trading level in the pre-market hours or after-market hours, and then reading it. If there is, if you look at the CRM chart on a daily basis, you will see on the daily basis, you will see the 190 level was a big resistance. So 190 level was a big resistance where the CRM has previously uh, um, crashed. So if it opens at 194 during in the regular session, the 190 is not that far from 194. And if it goes below 190, I mean, all the buyers who have been holding CRM for 190 level, this is their day to sell. I mean, this is their day to sell and get out at break even. So usually the break even price of all the, if you combine all the traders, their break-even price somehow comes out to become the major resistance. That's the way the market works. It's some natural thing. The break-even price is the, of all the traders, is the major resistance. So we have AI positions. So I have a friend John, and I said, hey John, the AI gapped up 18%. It's trading at 25.50. So he immediately sent me text. He said, my break-even, my cost is 26.50. And I was about to tell him that 2650 is the resistance. It needs to break the 2650. And then here he is. He bought AI in various chunks, small lot, 200, 300, 500, and his break-even cost comes to 2650. So how come that happened? Magically, his break-even is the same as the resistance. So if the break-even or the resistance is 190 for CRM, and it breaks above 192.90 at during market hours, it traded at 194 during pre-market hours, then it shouldn't go below 190. If it's going below 190, then I don't know how far it will go. My objective becomes to sell immediately. So I need to sell immediately. So in case of CRM, not only the red target was revised from 175 to 194 or 190, but then I need to see if 190 is being held. If it's not, then I am selling, and I better sell in no internet. You know, sometimes when you try to sell and the internet goes down, let's say internet, oh my God, the internet down, and then you forgot your password. You can't even log in, you paralyzed, or you so happen you are driving. So make sure your order is ready in such kind of a situation. So think about all the top traders. They have figured it out, everything. So sell immediately if it break below red. So that was the 190 was a high and it broke, so we sell the rest. So in case, so I send you the revised. So I'm giving another example. I did it in Roku or Airbnb. I'm giving you the target revision concept in like I have given you revised target, keep giving you revised target in LNG, keep giving you revised target in MOS. I keep giving you for Twilio, for Meta. So when the stocks are moving, the targets are being revised for the members. I don't know who is holding what. So they may have sold all in green, but there may be some members who are holding it for red. So when that happens, I send you the revised red target, because markets are dynamic. You need to be flexible. Traders cannot be rigid. You need to be always thinking in terms of what the other guy is thinking, what I'm not thinking, what he is seeing, what I'm not seeing. I mean, when you are like if you are in the court, when two attorneys are fighting with each other, the one attorney is thinking what the other attorney is thinking right now, what I am not thinking, what I should be looking at, what paper he will bring in the court. So same way, what kind of a trick these other traders will pull on me, and I will be left behind. Either I miss out on a big profit, or I miss out on taking my profit, or I miss out on taking the loss. So various reasons to revise red target. Red target is revised to capture more gains. So that's the objective. So when we have a long trade, then I revise the target upward. When we have a downward puts, then I revise the target downward for the puts if I see it. For instance, I give you examples. Guild. So I expect gilt to fall. I'm holding puts on gilt, and I'm expecting, I don't know what the gilt is doing right now. So right now it's going up. So I expect gilt to fall, and I'm holding puts. But it doesn't mean that I'm expecting gilt to fall and it's going up. I mean, it can go up. So, but I expect gilt to fall. And when it starts to fall, I'll revise the same way for BABA. I expect BABA to fall more from the 88 level. So I'm holding my puts on BABA. So when we see the more downward pressure, we are more potential. We need to revise the target for the puts also. So I send you the target. The first target is the target, which was the second target. Second target is the first target. If we have sold already, is fine. I cannot. I mean, it's okay. Sometimes people I receive email. Hey, you send the target. I already sold this. So okay, then buy on a pullback. So target may also shrink. So just like the targets are expanded, the targets are expanded, the stock is telling you that I am going higher. So you're expanding the target. It's like you're putting air in the balloon. So you take out the air, the balloon shrinks. You put the air in the balloon expands. So same way, the stock expand. It tells you that it's going higher and higher and higher. So you need to constantly revise your target. And it tells you also, no, I'm not going higher. I'm just gonna dwindle here at this level, and I'm going opposite of what you're thinking. When that starts to happen, you recognize it and you shrink your target, and then take whatever you have available. So I do that. I sometimes I revise the target to the downside, and I have an arrow. So I show you in the email a down arrow, or in the SMS in a down arrow. So when you see the down arrow, it means the target has been revised to the downside. When you see a green arrow, it means the target has been revised to the upside. So make it visual for you. Another thing, which is the last thing, is understanding the multiple exits. So uh, there could be only one reason to buy. You see it, you feel good, you recognize it, and you enter in the trade, and that's it. But there could be thousands of criteria for exiting. So understanding there should be multiple exits. There could be exit protocol triggering on thousands of variables. So the more variables you have, the better off you are in managing your portfolio. So understanding multiple exits, understanding that you should be buying in multiple lots, not in one lot, understanding that you should be able to trade multiple markets, and not only on a multiple market, but a multiple market in the stock market, but multiple uh, financials. So multiple things. If the more knowledge you have, the more better you become as a trader. So more knowledge you have about the multiple exits. So selling 1/3, then selling half. I'll create a better matrix where I will show you, when we send you to sell 1/3, what's the next step. So you can expect that this is what he's going to send me. So selling 1/3, then selling half, or selling majority, or directly selling half or selling majority. And the selling rest comes when we do one of those things: 1/3, 1/2, or majority. Selling all, sometimes selling all comes directly without any other trade alert. So just send you the sell alert that need to sell all. Sell price range, sometimes I give you the price range. The bid and ask is wide, or the stock is moving up, and let's say the bid is 950 and the ask is 10, and the stock is moving up. So I know the stock is moving up by the time you act, or it has room. So I give you the range. I give you the price, which is not there yet, but I expect it will be there in few minutes or half hour, 1 hour. So I give you that price range of the option, and I also calculate the option price based on the formula. Based on the stock target, I calculate the expected option price, and I send you that also, that this is the option price I'm expecting. So set that target, and if I send you the sell alert before, then you just cancel and sell it. Otherwise, you have the expected option price based on all the targets. And then there's another one, last alert is the sell to close by market. If the market is moving up, or if it's moving up and I don't know how far it will go, it just keeps going up, then I send you that kind of alert. Or If it's trading near break even, I send you the alert to sell to close by market to just get rid of this trade. It's not, uh, it's not worth it. So there was one trade, two trades actually. One was a play trade. So I closed yesterday, play, PLAY, at break even. It failed. It was not moving the way it was supposed to move down. So I closed it at break even yesterday, and today it moved up. WDC also sold at break even. It was not doing its thing, which I expected, and so I closed that. So another one thing which you need to pay attention is the pre-market and after-market price action. So you need to pay attention to what is going on in the pre-market hours and after-market hours if you are in a position, in that position, and the earning event, especially the earning event comes. So red target can hit in a non-regular session, which happen in CRM and way beyond. Event occurred. What event occurred? The earning event occurred. Chances are stock will pull back during the regular session. So if you don't know the high made during the pre-market hours, you're missing out in making a decision. So I give you example, AI. So AI yesterday was trading around 25.40, 25.50. So that was the thing, that AI must trade above 25.40, 50 in order for to feel good. I mean, it can go down to 24, but if it's going above 25, 40, 50, I can add more to my position. I can buy another 100 shares or 200 shares because the after market hours was 25.40, and now it's trading at 25, 60, 70, 80, and then 26 above. And another line in the sand is 26, 26.50. Then ultimate is 28.20, and then beyond 28.20, I don't know. Maybe it can go to 100. Who knows where it goes? So chances are stock will pull back during regular session if your red target is hit. If some major resistance is hit, the stock must gap above red for calls and below red for puts. So the red target is, well, let's say 190. So during market hours, it's trading at 190. During regular hours, it should gap above 190 and must continue its journey. So after gapping out, it must continue its journey. If it comes back to the river, so it took the flying carpet and it went on the other side, and then it comes back, and now you are in the river. So the chances are you will end up on the side where the dog is waiting for you. So you don't want to go on that side. So you must sell, close your position. So must continue its journey on the other side. Pre-market alert and strategy is sent to members. So when this kind of phenomena happening, I'm sending you the alert and strategy. There are many strategies. So the strategy, the simple strategy I give you is to hold it. But then you think about it, what else you can do when this kind of phenomena is happening. So write down all this, 1, 2, I can do this, I can do that. There are, at least you will find 10 different things what you can do when the stock is gapping up and you have a big profit. At least 10 different things you can do. So I can create a present teaching 1 hour, 2 hour session on what you can do when the things are moving in your favor. And you want to lock your profit and want to go for other more profit, or you don't, you want to limit your risk now, want to make the trade for free. So you can make the trade for free, you can limit your risk, you can pile up, you can lock partial gain, you can do 10,000 different things depending on what the stock is doing. So that's what's called the strategy. So knowing all the strategy at any given time. How to maximize gain? Adding to the existing position is a good strategy. So adding to the existing position, even at a higher price, is good. If you bought something at 100, expecting it to that is going to 110, and 103, you see it still looking good. Maybe you want to buy a little bit more at 103. So you can do that. Maybe you sell that strike and buy new strike same month. If you're holding April calls and your option is way, 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 way deep in the money, already in, so the delta is 1, and maybe you say, okay, I need to lock some gains and buy the new strike. You can buy some new strike way higher above than what you have, maybe same month. Maybe you sell your position and buy out of the money calls, way out of the money for all the profit you got. So you had 10 contracts, you sold, you lock all your gains, and now you bought out of the money calls. And instead of 10, now you have maybe 40, 50 contracts because the profit is so much that you sold all your in the money calls and you bought some out of the money calls from your profit, not your original position. So now you have a free trade going. Buying new strike and next month. So if you have an April call and you say, no, April doesn't have much time, then maybe, and then its stock is trading way above, maybe you can buy a new strike in the month of May or June, etc. If you have, maybe you can short this against your long call. You can sell the short, you can do the higher strike above out of the money. So you collect that premium. Now you have created the spread, and so you lock your gains by selling the short. Now you know that when the stock rises, you will have this maximum gain, and this is your maximum loss. So you can create a vertical spread. So many things you can do. I provide you news update if there is any. Otherwise, news are available for you unless it's something extraordinary. The news are there online. You can read technical analysis update. I send you something, some comment. If I see something, what is happening, I give you this kind of webinar. Volume update. If the volume is unusual or something high, I detect. Then I send you update, and I constantly send you the update to log gains. Get ready to log gains or the targets update. So I do that. I also send you the update on buying more. So this is, I will show you the chart on a dollar cost averaging. So dollar cost averaging at the right time is the ultimate strategy, but to accumulate wealth, but it needs to be deployed properly, because if you keep adding wrong at the wrong places, that we are adding good money after the bad money, and then we buy parts. So we need to add at the proper places. So if I see the opportunity, I send you the alert to buy more, such as buy at 6, which we bought at 10. And if you do the study on a dollar cost averaging and you're doing it properly on a volatile market or the market which is going up and down, you can make a lot of money compared to just buy everything in one lot. Traders have a tendency to buy everything in first round. That's it, boom, they buy it because the greed is there. They get excited and the greed kicks in and they buy everything in one lot. That's it, and then nothing. So it can work. Most of the time, the trade is not going straight to the uh, target. So I send you this alert. Last thing is setting the conditional order, which I have another presentation. So if you don't know what will be the expected option price when the target is hitting, then you can set your sell order based on the conditional order. So conditional order is another set of telling the market to sell my option at market, my contract, that option contract at market based on some event. So that event is what? The event could be the target hitting. Even it could be you have Apple calls, and the event is when QQQ hit this target, sell my Apple calls, or by the market close, sell my Apple call, or I am selling Apple when Baidu hits 100, sell my Apple calls when Baidu hit 100. So you can do all kinds of this techniques for conditional order, but to be simple, you're selling your option contract when the stock target hits. So there is this, you can call your brokers to learn. I have another presentation on YouTube channel you can watch on the Real Trade Genie. These are the recent winner winner trades. So I just prepared. These are the recent winners, and it doesn't mean that I don't have losers. I do have a loser, but I have more winners than the losers. And when you combine overall, then you should be the winner in the market. You see this winner I have is a BG put. I just made break even as 5%. So having some big winners and having some break even winners and having some losers, overall your portfolio should be going up. Here are some more winners. Here is Airbnb due to earning. Whenever you see triple digit gain, it could be either the market moved up big time fast, or it's because of some event. So Airbnb was an event occurred, earning, and it gapped up. Moss, there's no earning, but Moss is moving up, and we are up 100%. So there's no event, but it's just Moss was caught at the right time. So that's all I have to say, and I'll see you maybe next week. And if you have any question, please send me email. Otherwise, I'm going back to the market and see what else is going on right now. Okay, so I'll talk to you later. Bye.